This webinar is about cash flow forecasts and what it means to your valuation, as we can see in the slide here. So I'd like to introduce Michelle. So we're just going to do quick introductions and go straight into the content. So go ahead, Michelle.
Great. Thank you so much for having me, and thank you again to Maya for hosting this event. I think it's absolutely timely. So I'm excited to be a part of it. So thank you for that. Just a little bit about myself. So I've always considered myself a business professional who has accounting training instead of an accountant. And I've spent my entire career in industry, mostly in tech, and mostly with a seat on virtual leadership tables. So I'm used to working remotely. And earlier this year, I decided that I would go off on my own and use all the tools and experience that I've accumulated over the years to start a business consulting practice. I'll go to the next slide.
Great.
So just a little bit about Virtually There CFO Services. So when I think back over my career, I can attribute a lot of my learning from working from other professionals in all areas. And I've been fortunate enough to work with extremely talented sales leaders and CEOs and rockstar HR talent. And I've experienced the power of having the right people around the leadership table, as well as having a team of talented folks to support me. And I've also experienced how having accurate data is critical to being able to have a productive business discussion. So the companies that I've worked with were all companies of 20 plus people, revenues of 5 million plus. But I thought, what about all the startups, and what about the smaller companies that are just trying to grow? So even if they could afford the caliber of talent that they need to get them to that next level, it's often really challenging to be able to recruit them because of their size. And so this inspired me to create a company where small and medium-sized businesses can have access to a team of experts if they need it, or simply ensure that they have accurate and timely financials with an experienced set of eyes providing insights to help move the business forward. And so also my philosophy is I wanted to make sure that you know, the client doesn't have to be hesitant to have a question answered or bounce ideas around, because that hesitancy is bad for business, and I'm all about helping businesses succeed. So that's a little bit about me.
Great. So joining us today, we're to add some additional context, is Rick and Mike. So if you both just want to give like a very, very brief introduction about yourself and who you work for, so that the attendees here can get an understanding of what your background is, so they know where you're coming from. So just briefly, Rick, you want to go ahead?
Great, thanks, Mark, and thank you to Maya for all your support in the Vancouver tech community. It's very meaningful. I've worked with yourselves in a couple companies within town, and you've helped us a ton. My background, 20 years in tech, playing as the COO, CFO, and helping founders, or a bit later stage, to either scale their companies or pivot their companies, kind of $1 to $10 million. And right now working with a great team at Seven Geese in performance management, and really enjoying it. And thank you to Maya for your support here.
Great, thanks. Mike, go ahead.
I was muted. That's me in a wind tunnel in that picture. Well, I don't know why that picture keeps showing up.
Good photo, Mike.
I'm Mike Walkinshaw. I'm the CEO of Tamaya Capital. We finance recurring revenue software companies with a revenue finance product throughout North America. And I'm looking forward today to talking about how cash flow forecasts in the companies that we look at, how they're perceived versus maybe how the entrepreneur is perceiving them, and really talking through about what would be, I think, helpful for both the entrepreneur and for us in cash flow forecasts that are created and how it affects your valuation of your company and your ability to raise capital.
Great, thanks very much. So we're, as we go through, go ahead and post a question in the Q&A panel or raise your hand to add some additional context. We're gonna start off by just getting a temperature check on everyone. So we're gonna do a poll here on just for what your reason is for joining the webinar. So the poll is, you're just gonna see the bold, the green bold letters as an option. So are you looking for additional funding? Are you looking for best practices? Are you looking for coming in the next 3 to 6 months that you're planning, or are you looking just to expand your knowledge? So I'm launching this poll now. Go ahead and fill it out. It is anonymous, so none of your responses are directly correlated to your name. We're just trying to look for an idea of where you guys are at so we can help tailor this webinar. So we've got quite a few in here already, 29 out of 41. So 70% of you so far, education and research, 20% planning stage, and 8% immediate needs. So thanks very much for filling that out. We've got 90% of you that's filled it out so far. Yeah, so 70% education and research, 20% planning, 10% immediate need. Thanks for doing that. Thanks very much. I can share those for you. All right. Next up, we're gonna do what kind of company size are you? Pre-revenue, greater than, are you just under 1 million ARR? Are you between 2 and 5? Are you 5 plus? So next question, startup, company size. Again, this helps us craft, Michelle will take this information and help her craft what she specifically talks through through the content that she's developed. So thanks everyone. We got 30 people so far voted. So we have 13% startup pre-launch, 40% recently launched, 30% traction, and 25% established. So there's answers pouring in, so the ratios are changing as I mention them. So thanks everyone for voting. Got about 36 people who voted. Thanks very much for that. So here we go. 40%, so recently launched, so you're less than 1 year, just under 1 million ARR, but then we have quite a few, again, 26% with traction, so you're between 2 and 5 million ARR, and then 25% greater than 5 million. So a little, quite a good mix there, quite a nice mix. Over to you, Michelle.
I suppose I should probably unmute myself, right? Okay, thank you. And thanks for that information. That's great. So whether you're seeking equity funding, debt financing, or looking to sell, each of these elements are important to putting together a comprehensible and a defensible cash flow forecast. So the cash flow forecast is a financial articulation of strategy and significant milestones which translate into the impact on the business through improvements in key metrics. And then there's a trajectory of trends that, supported by a clear strategy, help funders and our purchasers gain a level of comfort on how realistic the forecast is. And finally, identifying risks and upsides in a cash flow plan are important in assessing the variability in the forecast. All of these elements combined will improve your valuation because not only do they communicate your future state, but also your ability to execute on the strategy and the tactics that are needed to get there. Any comments from the panelists?
Not yet.
Not yet. No, we're good. Okay, excellent. So, so that's the ideal state. I'm just gonna flip down. All right, so when we're talking about strategy, there's good strategy, there's poor strategy, and of course there's ineffective strategy. So a cash flow forecast without a strategy behind it is really the financial manifestation of a dream that may or may not come true. So a good strategy provides clarity and focus. It aligns the organization, and it makes saying yes or no to opportunities easy. And more importantly, it helps all the members of the team know if they're winning or losing the week, the month, or the quarter. A poor strategy, conversely, is very complicated, it's uninspirational, it's too broad, it's difficult to remember, it's not communicated. There's nothing special or specifically linked to how the organization is differentiated within the market. And then, of course, an ineffective strategy is very akin to a piece of exercise equipment, which in reality is really an expensive clothing rack. So the quality of the strategy will absolutely impact your valuation. The clearer the strategy, the easier it is for everyone to execute. And execute post-close is the focal point for everyone.
And Michelle, I'd imagine in your seat as VP Finance, CFO, different roles you've played, the clearer the strategy that you have had from the team around you, the much easier it is to snap that forecasting mechanism to it, so that the communication just from a strategic perspective, but then supported by those numbers, both internally within the company and then to people like Mike, is just so much easier to deliver.
Yeah, absolutely. Absolutely. And I've worked with companies where we've started with the funding goal in mind and then tried to work backwards in terms of, you know, if we had a bucket of cash, how would we spend it? How would it impact the organization? Without really thinking about, okay, what's the vision? What do we really need to do? How are we going to execute it? What's special about us that we're going to leverage, and then putting some timelines and milestones and tactics as far as, you know, what do we need in order, how much gas do we need in order to get there?
And you need to inspire your internal team, as you said. And then Mike, I'd imagine, love your take on this, but I would bet you have seen a lot of spreadsheets and forecasts that aren't hung together with a really, as Michelle says, clear, crisp vision of what we're trying to do as a company.
Yeah, I think we're going to talk shortly about key metrics, but for me, a strategy is the laying out of where the business should go because the metrics make sense for you to go there, and where you should not go because the metrics don't make sense. And a management team that understands this difference between where the business is going to be successful and where it's not going to be successful, as laid out in the strategy, is really a business that you want to invest in, versus a management team that doesn't have that clearly laid out in terms of the underlying metrics, even if they're thesis at that point, because you're laying out your best guess at that point. But that is really fundamentally the difference. A management team that can lay out those underlying metrics to how the business is going to perform under certain strategy options. We'll talk more about that in a second, I think.
Yeah. Mark, do we have a question?
Yeah, so we have a question about forecasting sales, best practices in forecasting sales. So this individual is saying that typically they can forecast expenses within 2 to 3%, but sales, or an influx of cash, are more difficult. So the challenge there is missing a sales target, or customers missing payments, et cetera. So how do you go about forecasting what your sales team can provide? And Mike, maybe you want to add a little flavor on this, because what we do is we typically look in the past. So I mean, that's what I would start on, is look at what your sales team has been able to do in the past. So go ahead, Michelle.
Yeah, I'll jump in on this one. So presumably the underlying individual is a software company. If not, I think the same principles hold true, but maybe aren't as easy to measure. So CAC to LTV ratios, revenue per customer, salesperson performance in terms of new bookings or renewals on a yearly basis, churn percentages are all metrics within the software space that are well known and well understood. And there is, if you've been in business for a while, there is a well understood historical performance that the company has delivered. And the assumption is if you spend more money on sales and marketing, those same past metrics will hold true in the future. So that is the easiest scenario, and perhaps what the situation you're referring to fits that scenario, where you can now forecast into the future as long as those ratios and measures that were historically true are the same into the future. Where we find trouble under that scenario is if the measures and ratios that were historically demonstrated in the future magically change to a new set of numbers. And obviously 98% of the time they're better. So why? And that goes to the strategy question, is why are the metrics of your business going to change suddenly next month after demonstrating a certain set of numbers for the last 12 months? So management needs to have, if that's true, needs to have support to underpin why they believe that those metrics are going to change versus certain improvements. So new sales tools that they're going to bring in, changing out salespeople for new salespeople who have a demonstrated performance. Other options are there, but there's always a high level of skepticism from any investor looking at the underlying metrics of the business dramatically improving as soon as new money comes into the company. Where it gets harder is now you've got a software company that doesn't have demonstrated sales performance. So I would suggest in that particular circumstance that there are industry benchmarks you can go to for products that are probably similar to yours, and build your model based on those metrics. And any investor who's coming into a brand new business will take comfort from the fact that you built your sales plan at least on a set of metrics and you have a reference point for them. Even if you're not able to hit those, or you exceed, or you underperform, at the very least you gave it enough thought in your plan to be able to go out and think, well, there's a comparable for what we are, and we think we ought to be able to do that. That's a good step forward as far as I'm concerned on the underlying metric. What investors don't want to see is a sales plan that's based on vaporware and doesn't have those underpinnings to it that would allow a rational conversation about why you think that's the case.
Yeah, I think if I can add, every time that there's a success, or every time that there's a failure, there's something to be learned about it. Yeah. And so the reason, so again, it's really digging into understanding the root cause. So what was a set of circumstances that caused you to think that you were going to achieve a certain revenue objective, and then what actually happened? And so I think definitely stage of a company, it's trickier. So startup or early stage is super tricky, because you're still trying to, as Michael had said, you're still trying to figure out your groove as far as what works, product market fit, pricing, all sorts of things. But my advice is go back to the root and try and explore what's the learning of it that you've experienced with the missteps before. And then you can always provide a best case, worst case, most likely scenario, which we'll talk about later on in the presentation.
Michelle, just to layer on to the stage of the company, I think that's such an important point. We're going to be talking about it in a sec, but whether you're startup or recent, or if you have traction, or you're, as we've said, you've established yourself in the pool, there is one consistent metric that's really useful, and that is your CAC. And so you want to be able to look backwards, say 12 months, and be able to take your sales and marketing spend divided by your CAC to figure out how many customers or how much recurring revenue you're going to have going forward, to make it really just simple. And then when you're going out to raise money, you're going to have a strong thesis as to why, if you say double your sales and marketing spend, that you can maintain that same level of CAC. And that's where, to tie it back to the strategy and the execution, your story has to hang really tightly together with your metrics. But it all comes down to that sales and marketing over CAC, and forecasting out your your revenue going forward.
We should maybe define those terms. I think we've thrown around a few acronyms. So just in case it wasn't already defined, LTV is a lifetime value of a customer. So the annual contract value divided by or times an estimate of the number of years you're going to continue to have that customer. And then CAC being customer acquisition cost, which is how much did you spend in sales marketing divided by the number of customers you got, new customers you got in a year. So at the very highest level, far more complicated ways of calculating those, but at the very highest level, that's what those are.
Great, thanks, Mike. Michelle, I'm going to move on to the next question here. Is that okay? Sure. Just so we have some more understanding from the attendees here, and thanks everyone for being engaged. We have a brief question here for you. So when you're looking at your finances, what importance do you put on that financial impact on your business? So are you just looking at cash flow? Are you using it as a review mirror? Where are you looking at your monthly reports? Is it something that you kind of have to do? So you review finances weekly and possibly twice a month, or are you a financial ninja? So let's see where everyone's at. So we got a bunch of responses here coming in. It looks like about 50% of you are cash flow based businesses. And then a couple higher up as well. So, and that percentage is going down. So about 20% necessarily evil, and about 25% of you are financial ninjas. So so thanks everyone for filling that out. And I'll share it here with everyone. Michelle, can you see these results when I hit share? Can you see them as well?
Yeah.
Great. So that's kind of where we're at. Okay. So let's go into some milestones.
Yeah. Right. So milestones. So when you're pulling together your cash flow forecast, it's really important to not only articulate how much funding you require and what you're going to use the money for, and of course, to Michael's point, what the impact is on metrics, but it's important to articulate your company's achievements to date. This provides context for funders in terms of what the current organization is capable of doing. And obviously, it's important to communicate what the funding is going to be used for and the measurable outcomes. But the context of organizational capability, as well as having clear measurable outcomes, are one of the many sense checks that funders will use to assess the achievability and therefore the risk associated with the cash flow plan. And so the higher the risk, obviously, the lower the valuation. Thoughts on this? Questions? All make sense?
Nothing from me.
Yeah. Okay.
So we're going to ask you attendees again, as we're just talking about metrics, when you're thinking about your businesses and looking at the finances, what kind of metrics play? So we're going to put up a new poll for you here in a moment, and then we're going to dig into these metrics as Mike alluded to earlier. So when you're thinking about your business, what is the number one thing that is important to you. All right, we got loads of responses coming in. Thanks everyone for participating. The early leader was Runway, but the CAC payback in months is picking up.
Yeah,
so right now we've got most of you who have voted now. So 20.
So, sorry, Mark, I was going to say, maybe just so for those who don't know the metrics, I think we just sort of defined them briefly,
Sure.
but customer acquisition cost payback is very simply that customer acquisition cost I talked about earlier, but spread over the contract value, so that it just says, given an average customer acquisition cost, it takes you 8 months to pay back. And then if the contract is average 5 years in length, then the remaining 4 and a bit years is gravy, so to speak. LTV to CAC ratio.
I'm going to share the results of this poll, and the next slide we can review that. Just 1 second here.
Okay.
So thanks everyone. So Runway seems to be like the #1 thing. CAC is #2. So thanks everyone for participating in that. Mike, here's the slide. Take it away.
Actually, I'm going to pass this to Michelle because this is her slide. I apologize.
You were doing a great job, actually. I was like, tell me more, tell me more.
Trampled all over it. I apologize.
No, that's awesome. Okay, so some key metrics to include in the cash flow forecast are kind of grouped into 2 different buckets. So you've got KPIs that measure sales and marketing efficiency, like CAC payback in months, as Mike had explained. It's really how long does it take for your investment in sales and marketing to so that you break even from a client acquisition perspective. And then there's the LTV to CAC, which is a really important metric. And that basically includes, how long the average client stays with you. This can be a little tricky to calculate, again, stage of company when you're starting out. And then there's the magic number, which is basically, it measures the sales and marketing team efficiency. So for every dollar that you spend, how much ARR do you, annual recurring revenue do you create? And then we've got, let's see here. And then we also have some cash flow metrics. So combined cash burn, your cash balance, and your cash out date, or your runway, are indicators on how much breathing room you have to run experiments, such as adjusting pricing or marketing campaigns. You also want to have the option to turn off the tap if an experiment doesn't go as expected. So, so what I've seen is, wherever possible, using contractors, and also having a clear expectation on how long you're going to need to run the experiment, and having some key measurements or KPIs to make sure that the cash is being used wisely. Of course, those metrics typically being the LTV to CAC and the CAC payback.
Right. Michelle, I've often been on the other side of listening to speakers and panelists, and you get all these numbers thrown at you, and it can be incredibly confusing, and you have these charts, and here's where you need to get for each metric. Just in my experience right now, over the last couple of years, what I have really focused in on are 2 things. CAC payback is so important. So if you can have your CAC payback in under a year, and you are signing longer than a year contract, that's really, really meaningful, because you spend to get an extra year of revenue, essentially, or a couple of years of revenue. So that's an important one for me. Cash metrics, and we're going to touch on COVID in a sec, but COVID has changed how I have viewed just this, my cash. And what I'm wanting to do with cash right now is I want to make sure that I have enough cash in the bank to get to the point when the economy starts picking back up. And so it's more conservative perspective right now. And from a valuation perspective for cash, what that means to me is I'm preserving my valuation. I'm keeping it at minimum, I'm keeping it flat. And if I can grow on top of that, which we are, then even better.
Look, there's a Q&A in there. Somebody pointed out that ARR or annual recurring revenue is probably the most important from a valuation perspective, and I just wanted to address that question. It's true. The very first question that any investor will ask you is, what is your ARR? And then they will very simply apply a multiple to that ARR after a brief understanding of your business. So if you're a pure SaaS company and your revenue is greater than $3 million, they will say, okay, that's a 3x multiple on ARR or a 4x multiple on ARR. And if you're a SaaS company, with revenue of greater than $8 million, for example, then your multiple might be more like a 6x your ARR. And so there's an expansion in your multiple as your ARR moves up from small to big. But I think the important point is that that's the first conversation, and it's a 5-minute conversation. And the real meat of the valuation conversation comes in as your investors and potential acquirers step into these metrics. And that it is these metrics that will affect whether your multiple is 6x, 7x, 4x, 2x. And your ability to be able to demonstrate that you have great underlying metrics in your business dramatically affects the multiple on ARR that your business is valued at. I hope that answers the question that was posted.
That's great, Mike. Thank you.
Yeah, that's an absolute great point.
Michelle, do we want to look at those metrics on a spreadsheet?
Yes, we do. Let's go to the next slide. Okay, so what this is a hypothetical situation. If you can click. Okay, so what we have is we have 12 months of actuals and 12 months of projection. And so when we're looking at the 12 months of actuals, we can see in the first quarter that the cost of customer acquisition is quite low. Our magic number, and so the magic number is really about, do you have repeatable sales processes in place so that you know that if you add more funding, you can you have a high degree of certainty of what's going to come out the backside. That's really the purpose of it. And so when we're looking at this, in this particular scenario, we've got a founder who is doing a bulk of the selling, which quite happens early stage organization. If you want to click to the next. And then what we see is we have some new sales hires, and so what that does is it increases the costs of customer acquisition significantly for that particular quarter. And then if we click again, and then we're seeing a bit of a decline in or a decrease in the cost of the CAC, and that's because we're seeing that the sales reps have ramped up, which is great. So now they've gone to now they want to seek some funding. It looks like they want $2 million worth of funding. And if we look down below, you can see that their runway, how much breathing room they have, goes from 6.5 to 4.9 to 3.3, etc. So the ask is $2 million, and the majority of the funding is going to go towards investing in sales and marketing. Let's click again. Excellent. Mark, you're really good at this. And so what we're seeing here is there's a lag. So we can see that the cost of customer, so we can see that we've got significant investment. This is an optimistic plan in that the cost for customer acquisition significantly decreases over the final 3 quarters. So this is a situation where, and I'm sure Mike can speak to this a little bit in a little bit more detail, this particular scenario might drive further conversations about, help me understand why the cost of customer acquisition is going to dramatically reduce from, calendar year 20 Q3 to calendar year 20 Q4, because all we've done is added money, and then the next quarter we're expecting that it's going to decline significantly, and we're going to get the sales efficiency that we expect. Yeah, maybe Mike, do you want to?
Yeah, I'd be happy to.
Yeah.
Let me be a little.
I'm sure you've seen this before, right?
Well, yeah, and so honestly, when I see a cash flow forecast that looks like this, and what I'm looking at is the LTV to CAC ratio, so lifetime value to customer acquisition cost ratio, which is 1.9, 3.3, 2.7, 7.9. So we've demonstrated by hiring new salespeople and cleaning up our processes and maybe bringing in a little bit more, maybe the founder wasn't necessarily a salesperson in the first place. They just did sales because they had to. Then we hire professional salespeople and they come in, we give them 1 quarter and they've delivered 7.9 LTV to CAC ratio, which is a good CAC ratio. That's a good LTV to CAC ratio. And, generally anything above 3, depending on how you calculate it, anything above 3 is a good LTV to CAC ratio. So this business, in our opinion, would be a good bet to put money into to fund sales and marketing growth, because we feel like the value is going to come out the back end will exceed the value put in. But where I would have a problem with this very specific scenario is the next 2 quarters, we see an LTV to CAC ratio that is matching proven performance, 7.9, 7.2, and then we see this magical 12.7, 22.0 on the last 2 quarters. And honestly, I would look at that and I would say that's a business that's going to need more money in the 4th quarter, because I don't understand how we're going to double or triple our LTV to CAC ratio without some really magical stuff happening. And speaking of magic, because one of the participants mentioned magic. So I would really, really dig into why that 7 is going to turn into 22. What exactly is it that's going to make that happen? And so once I have that answer, I'll either buy it or I'll believe it or not believe it. But in any case, this business, given their LTV to CAC ratio, is definitely a candidate for further financing. I think it would only devolve into a conversation around, does the company need more financing in calendar quarter 2 of 21? And I think I would assume it does. That would be my output.
Just to be conscious of time, I think we've done a great job of covering this up to that point. So unless anyone else attending has a question, we're going to move to the next, where we're going to ask a quick question of the attendees of where you are with COVID and how it's affecting you. So I'm going to launch a poll here, and then we'll move right into the risk and upsides of cash flow forecasting. So question here: how have you been impacted by COVID? Have you taken a hit? Are you unaffected? Is it positive? There's a poll appearing on your desktop as we speak. So thanks everyone for participating in our webinar today, trying to keep it interactive. So it seems like actually quite a lot of you have had a positive impact. Looks like about 30%, unaffected 25%, and taken a hit about 40%. So that is most of the attendees here that have voted. Couple more coming in, trickling in here. So that's about what I responded to. So I'll share the results here. So yeah, about 40% have taken a hit. Interesting that about 60% of you have either been unaffected or positive. John, thanks for jumping in. Product demand has risen, but the pace of closing has slowed down because of COVID. Yeah, we've seen that through our portfolio companies as well. Thanks for adding a little bit of context there, John.
That's great. Okay, so on to risks and upsides. So cash flow forecasting is tricky, and there's a lot of variabilities. So especially as we've experienced with COVID, sometimes you know, unexpected positive things and sometimes unexpected negative things. So I view a budget or a forecast as a set of assumptions that may or may not come true. That's like, gee, that's helpful. But I can definitely guarantee that how you plan the year will never be exactly how it will end, because there's too many variables and unknowns to get that precise. So, and you've all experienced this, you'll either exceed your projections or fall short, and rarely in the exact original way that you had anticipated. So there's things like staff turnover and clients churning and new opportunities which present themselves. Sales members ramp up sooner rather than or longer. They take longer than expected. All sorts of things happen, and that's why it's important to be clear on the risks and the upsides within a forecast, and how to mitigate or minimize the risks and how to leverage the opportunities. So when we're sizing and estimating the risks and opportunities, this will also help funders or acquirers understand the soft spots in the forecast and the degree of softness, as well as the possibilities for the company without presenting a forecast that's either too conservative, which could reduce your valuation, or it's too aggressive, which will cause problems post-close. So using a best case, worst case, and most likely approach to forecasting allows the leadership team to set expectations and highlight areas to monitor post-close, either to the good or to the risk, to the bad. Chat.
Okay, great. Let's continue.
We're good. Okay. Right. And then the more mature the organization or the funding round, the more metrics and supporting evidence is expected. And so if you're an early stage company looking for seed or Series A funding or debt financing to fund growth to get you to the next funding level, then being able to include these elements not only helps provide additional supporting evidence, but also shows that you can play at a higher level. So being able to get at the data demonstrates a maturity of systems which are needed to support high growth. And for earlier stage valuations, the focus tends on being on validating product market fit and leadership team capabilities. So a clean set of financials plus a compelling story plus metrics to back it up reduces the perceived risk from either a funder or an acquirer, and therefore it can improve your valuation.
So Rick here, question for you. Any of these items, maybe specifically OKRs, how do you find that plays into building a plan and then actually doing a cash flow forecast, and how that impacts your valuation? Do you have a comment on that?
It's a bit of a softball question, given that our product delivers OKRs, Mark. Thank you. I think it comes back to what we started the conversation with, which is if you have a tight strategy that you can layer your metrics and your forecasting into, it both speaks internally that much stronger as well as to people like Mike and yourself. OKRs are objectives and key results, and OKRs specifically help drive that high level strategy and attach specific key results that you want to achieve. And if you can then tie those into your financial results on a very periodic basis, as in every week, but perhaps every month, then you can monitor your, not only your cash position, but also your valuation as you go forward. And you can do those small tests that Michelle was talking about, the A/B testing. Is this working? Isn't this working? So OKRs are incredibly valuable from a strategic perspective and tying it all together.
Yeah, I'd say they're also incredibly valuable in terms of just organizational alignment and making sure that when people have to make a decision individually on how do I focus my effort, am I going to spend my time, my week working on this versus that, if there's a clearly articulated strategy and then OKRs to support the achievement of that, it's really easy to get people to continue to focus on moving forward on those OKRs. So it's pretty powerful stuff.
All right, Michelle, anything else on this slide? Would you like me to continue?
Yeah, let's continue. Yeah, okay. And then finally, some soft stuff. So putting together a well thought out comprehensive cash flow forecast requires a good understanding of your business as well as the industry. While the actual document is a financial report, the quality of the information used to put it together speaks volume about the leadership and their ability to execute. So funders and acquirers are assessing the viability of the company, not only through the lens of addressable market, but also evaluating if the strategy proposed is the right strategy, or if the leadership team that's brought the company to this stage is the right team to achieve the next stage of growth. And equally important, it's important to know what you don't know. So for example, if part of the funding may be to run a marketing experiments or to test out a new market or region, or it could simply be to purchase information such as market intelligence, which is needed to firm up your strategy. So it's healthy to understand where your information edge is and how the lack of information affects your ability to run your business. And so these elements all help funders or acquirers assess the risk and the viability of your company, which impacts valuation. Any questions on that or comments?
Okay, so lastly, before we jump into questions and the last 10 minutes here, so thanks everyone for participating. Michelle, who are we pitching to here? Right.
So from a broad perspective, there's two different groups, and then of course there's subgroups underneath it. So so when you're seeking funding, you're either going to be pitching to equity or to debt. And because there's an ownership stake in equity, there's a different relationship and set of expectations than debt options. So with the debt options, typically the valuations are based on the current state and your ability to service the debt. And there's less attention paid to and less weight to the dream of the future state. And your relationship obligations are typically a monthly or a quarterly reporting, and annual budgets, and finalized year-end statements, and then maybe a quarterly check-in. With equity, the relationship is very different, and depending on the percentage of equity exchanged for the funding, there may be a board seat, there could be involvement or approval of strategy, and from a company perspective, there may be expectations from the investor of the investor to provide introductions to prospects, as well as assisting with sourcing specialized talent or providing support in something like an IPO. So when deciding whether or not to choose between debt and equity, it's important to consider where growth is at, how scalable the sales processes are, and how predictable the revenue is. if additional revenue or if additional investment is provided. So sometimes it's best to delay pursuing equity if revenue growth is a little lumpy or there are operational challenges that need to be resolved using debt. You want to be in a really healthy state when pursuing equity to get the most out of your valuation and minimize the amount of ownership that you give up.
Interesting, very, very interesting slide that opens up, a lot of conversation pieces around cash flow forecasting. One of the very fundamental truths that I've seen as both a venture investor and as now a technology debt provider is that venture capital funds are not interested in companies unless they are growing at a very high rate. And there has to be, for a traditional private venture capital fund to invest and take an ownership stake in a given company, there has to be the potential for that company to go public on the NASDAQ, for example, in the next 5 to 7 years. So for that to be true from near zero revenue or sub $1 million revenue growth has to be 200%, 300% per annum. What I have seen many times is people build cash flow forecasts backwards to make that multiple work. And when investors dig into the cash flow forecast, as Michelle has pointed out, the underlying pinning metrics aren't there and the whole thing falls apart. So what I think one of the key messages I'd like the group to take away today is build your best guess based on your experience in the market as to what this business can do. And then you can sit down and say, okay, I've made an honest assessment. You can have a high and a low scenario. And given this business, given the market's in, given the likely growth, given the customer behavior, the time for them to buy, the network effects, all of these things that affect growth rates, you say, well, I'm not likely to get venture capital financing because I'm just not going to exhibit 200 or 300% growth per year. Well, that doesn't mean you're not going to make a lot of money as a founder or management team. It just means you have to tune your financing option to fit the circumstances of your business. And that's where other kinds of financiers can come in. And it is, in our case, we lend money to recurring revenue software companies that have achieved a minimum level of customer traction. And in most cases, the people we deal with have the expectation that they're going to grow their business from $1 million of revenue to $10 million of revenue, and then they are going to sell it. And they're going to sell it at a 6x multiple, and the total sale of the company is going to be $60 million. And it is thus incredibly important to the management team and founders that they retain as much of the ownership stake of their company, and they get 60% stake when the company is sold at $60 million, and the management team walks away with a $36 million check, which is a great outcome. If the company has the chance of going onto the NASDAQ and being a public company for $1 billion, well, then it's perfectly acceptable for the management team and the founders to have 5% when that happens, because 5% of $1 billion is a big number. So it is incredibly important that this cash flow forecasting then feed into, well, what is my best financing option? And all of these options that are listed here are perfectly viable. And one of them is not getting any financing because you've got enough customer traction to be able to finance your business as you go forward as well.
So just as a temperature check, again, for everyone here, thanks for attending right to the last 5 minutes. If you want to open the chat and just let us know if we should cover this topic more or cover it more in depth, just go in the chat and just put yes or no. Just put yes or no and see if we can cover this information in a little bit more detail. We can have people like Rick and Michelle and even Mike, who have a lot of experience building cash flow forecasts. Maybe we can do another one where we dig in farther and actually create one live, for example. We could do that. So just go ahead and jump into the chat and just put a yes or a no. So before we jump into some questions here, I just wanted to say thank you to Michelle for offering her time and putting together some great content to share with all of you. She has a virtual CFO company. She's very experienced and has worked in small and large technology companies, SaaS companies. So just want to say thanks for her time for giving us this information. So back to the panelists. Is there anything here that you want to give some additional information to as some questions roll in? Michelle, Rick? Michelle, I think you're muted. There you go.
I'm muted, yes. Yeah, so thanks, Mark, thanks, Mike. It's been great to, and thanks for all the attendees to, to participate in all the feedback. I'm just watching the webinar chat feedback here, so I'm a little mesmerized by that. But yeah, it's been a lot of fun, and I think hopefully everyone learned something, and hopefully we can have more conversations in the future. So I appreciate that.
Great. So a question here, it's anonymous, and there's lots of some notes there in the chat. So Mike and Rick, if you want to browse through the chat, there's some things in there for you guys. So we have a very unique scenario versus traditional software companies. We have parallel business with an existing customer base. Customer base is ready and tested our software product. As a result, our CAC is near zero, but our software arm of our business is still acting as a startup. Given the restrictions from COVID, do you have any advice to finding support appropriate for a business requiring an injection to explode onto the scenario to help scale our product? So it kind of sounds like, and we can.
Hey, Mark, let me hop in on this one. I think I've seen this scenario a few times. So the problem underlying this is you have an existing business and you have a new business, both of which are under the same corporate entity. And in short, that provides a major problem for equity investors because they want to put a valuation on your business, but it's got some legacy business that is worth something. They don't want to pay for that. That's not why they're investing, but they want to invest in this software business because that's the exciting part. However, the ownership of the company doesn't want to separate the two because, as you've pointed out, there's some symbiotic relationship there. And so that provides a very challenging scenario from an equity perspective to be able to put a valuation on that and to buy a percentage of the company. Option A is to fund it from the existing cash flows. If that's not possible, then finding financing that doesn't put a valuation on your company, like a debt solution, is a possibility, and probably your best possibility, given the challenge in fighting the valuation battle that you're going to have over equity value when you have a combined entity. The other option is to spin the software entity out into its own new company and then try and put a valuation on that and fund that separately from the other business and have some sort of an operating relationship that recognizes the value of the cheap customer acquisition that this new software company is getting.
Thanks for answering that, Mike. If the question wants, the person who asked the question wants to provide some more information, we can take it offline and do that. So if you want to reach out, we can give you some additional information. Stephen, you're asking, can we get a couple quick comments on managing around COVID-19 on the go forward?
Quick response to that, given we're running out of time here, is what I'd recommend is that, Stephen, you really try and best understand at what point you believe your business is going to regain traction. It sounds like you're in a scenario potentially where you're not totally certain about your either your next few months or next few quarters. So make sure that, in my humble opinion, that you remain conservative and maintain the valuation that you've already established.
So Mike, I've seen a lot of blog posts on this recently, and even people like Steve Blanker are jumping in for the question of how many months of cash do you need in your business? So Steve Blank is saying something like 18 to 24 months? What have you seen?
Yeah, it's a tough one. We're looking for 12 months minimum cash in the companies we're in going forward. I do think that there is a there's a second downturn coming, which is going to come out of the back end of the ending of all this stimulus that's been poured in. But at the same time, I think software and tech generally has performed better than the general economy and will continue to do so. So there's sort of a negative there and a positive, but I think saving cash now is not the time to be pouring money into growth. Now is the time to be conservative and reserved. And I'm sure Rick would back me up on that. It's time to pull back, be conservative, conserve cash, and just try to make sure you've got at least 12 months worth of money rate going forward to get through this sort of coming downturn that we're going to see, I think.
All right, so we're a little over, so we apologize, but thanks everyone for attending. Diane, yes, we'll work on building a live example. I'll chat with Michelle and see if there's appetite for that. So thanks, Johnny, Dela, John, Brendan, Sue, Stephen, Martha, Christina, Alan. Thanks everyone for attending and being involved in the chat, in the Q&A, in the poll, etc. So we're gonna hang out here just for 5 more minutes to make sure there's no more questions. But with that, I'd just like to thank my panelists, Mike, Rick, Michelle for being here, and of course all of our attendees. I really appreciate the information, knowledge sharing that we're doing. And reach out if you have any additional questions. Happy to have a conversation.
Thank you, Mark. Good job.
Mark. Good job, Michelle.
Well done.
Thanks, Mike.